Hi folks, this is your host Mandeep. It's May 31st and I'm going to do another tutorial today, and just to let you know upfront, there's a free indicator that we're going to look at, which is the standard moving average converging divergence, and there's also another indicator which is a paired indicator, which is the moving average convergent divergence, but we look at it at multiple time frames. Now I'm also going to show you, a method that you can just use the free version and still kind of get the same benefit out of this trading system. So moving average convergent divergence is one of the most commonly used indicators, and so bear with me. And what I'm going to do is walk you through what the underlying calculation is for MACD, and I'll show you three ways in which the MACD can actually be used. From what I have tested, and I have empirical data for these trades, there's one way that works better than the rest of the others, right? And I'm not saying that's the only way. People probably have their own way of trading MACD, and if you're successful with that, please continue to do what's working for me. I'm just going to share what I've learned and what I've found to be the most valuable. So, how exactly is MACD calculated? Now, most people are familiar with the standard moving averages, right? So everybody looks at the 50-day simple moving average or the 50-day exponential moving average. Now, the only difference between the simple moving average and the exponential moving average is that in the exponential version, we pay more attention, or more weightage is given to data that is closer, right, to the last few days, versus the simple moving average, which is equally weighted. So there's other moving averages as well. There's like simple, there's exponential, there's weighted, there's Hull moving average, and they all vary in terms of the sensitivity of the closing price. But the MACD that we typically use is based on the exponential moving average, and in this case it uses a fast EMA and a slow EMA. So it basically looks at the 12-period exponential moving average, and then it looks at the 26-period moving exponential moving average. And the MACD is nothing but the difference between the fast EMA and the slow EMA. In other words, it is the difference between the 12-period moving exponential average and the 12 and the 26-period exponential moving average, right? Now, in order to further smooth it out, what we do is we apply a 9-period, moving average to the MACD. By doing so, what we look at is if MACD is trading above the 9-period moving average of the MACD, and if so, it's considered positive. Below that is negative. And what I also look at is another scenario where you have a diff, which is the difference between the MACD and the average MACD, right? And so if this difference is increasing, that means that you have a certain amount of acceleration to the upside or downside, depending on which way it's trending. But if the diff is more flat or moving down, then it's not as bullish, right? So we'll look at a couple of different examples to clarify. And I have a little bit of a color coding scheme that may seem a little bit complex in the beginning, but once you understand it, it's actually quite useful, and I'll walk you through that as well. So there's a couple of different scenarios that can happen, and the first scenario, which I call as bullish, is where the cyan line is the moving average, the MACD, and the yellow line is the 9-period exponential moving average. So in this case, the MACD is not only above the moving average, but it's also trending above the zero line, right? So I consider this scenario to be the most bullish, right? So MACD is greater than the zero line, and MACD is greater than the 9-period moving exponential average. Now here's where you have another scenario where the MACD is trading above the zero line, but it is dropped below the exponential average, right? So in this case, one way of trading would be you actually get out of the trade right here. What I'm going to show you is that oftentimes this just signifies a small pullback. You really don't need to get out of the trade. But we only do so if we have confirmation from other time frames, and we'll look at that in a moment as well. Now here's your option 3, which is the MACD is above the moving average, but it's actually below this zero line. Now, I'm not saying that you can't take the trade, but in my scenario or my case, I think of this also as a pullback, right? This stock is in a downward bias or a downward direction, and it is pulling back a little bit, and the likelihood either or is possible. It may continue, or this may drop again, right? But I don't look at one time frame, but 4 time frames to actually get that confirmation. And again, that's something I'll show that to you in a moment. And then we have the last scenario, which is your MACD is less than the 0 line, and at the same time it's also trading below the average. So this is to me the most bearish sort of condition, right? But if we can have these conditions sort of aligned in 4 different time frames, then it gives us a much better picture. And what we're going to do is we're going to take a look at a few examples. So there's an indicator, which is the free version of the indicator. It's called the MACD with prices, that you can install from the study section. And in my case, I also have another indicator, which is the paid version. And I'm going to talk a little bit about how I color code it and how I can look at it very quickly and analyze whether this is really sort of positive or negative. Okay, so the green color shows up when it is trading above the moving average, and also it's above the 0 line, right? So that's this sort of green scenario. But within this green, you also sometimes get this white, where this difference between the MACD and the MACD average is increasing. So once you have this kind of a scenario, it's really propelling the stock to the upside, albeit for a short period of time, but nevertheless it is, right? And you get these yellow when it starts to drop below the average, right? So it has dropped below the average, so the first time frame has turned yellow. So what we are looking at is 4 different time frames here. The first time frame matches up with what's the chart set to 15. So this is 15, this is 30, this is hour, this is 4 hours. And obviously you can adjust this, right? So if you go to 30 minutes, it'll look at 30 hour, 4 hour day. If you look at 4 hour, this will be 4, this will be day, this will be 3 day week, right? So you can essentially look at whatever time frames you want, starting from like the 2 minute or the 3 minute chart time frame. So that's all sort of part of the indicator. Okay. Now you get this cyan line, right, when the MACD has crossed the average, right, but it is below the 0 line, right? And finally, these red are the bearish conditions that we talked about, which is below 0, below moving average, right? Now, as long as so there are 3 sort of possible scenarios, right? So there's a primary scenario where I don't care about the fact that whether MACD is above its moving average or not. All you care about in the primary condition is that the MACD is trading above the 0 line. So even in this situation, it is still above the 0 line. So it's actually considered like sort of positive, right? So even though this has turned yellow because momentarily, the stock is retracing, but it's above the 0 line. The secondary scenario is when, when it trades above the average, right? Whether it's below the 0 line or above the 0 line is irrelevant. So as long as MACD is above the moving average, it's going to be, that condition is going to be true, irrespective of the fact whether it's above or below the 0 line. And then finally, we have a condition which is both, which means it has to trade above the 0 line and it has to be above the average as well. So that's sort of inbuilt into the system. So if you go back and look at MACD here, so your primary, secondary, and both. So in primary scenario, again, I'm going to reiterate, the MACD needs to be above the 0 line, and that's all that matters. It doesn't care about the average. Now, in case of secondary, you have the MACD to be trading above the moving average, but it's not important whether it's above or below the 0 line. And in both is the scenario where it has to be above the moving averages and above the 0 line. Now, I've done a lot of testing, and what I've found out is that this scenario, primary, is the one that actually gives you the best results, right? So as long as it's trading above the zero line, but on multiple time frames, you get the best result. Then the next best is the secondary, and then both you get sort of the least profits. And it kind of makes sense because you're looking for a very tightened condition, right? I mean, you're looking for it to be above zero, above the moving averages, and since it retraces quite often, this doesn't give you that much profit, right? So let's cancel this, and then let's start looking at a couple different scenarios, right? So let's look at a scenario here, right? So in this case, even though it's yellow, essentially it is above the zero line, and that's what we care about in this condition. So when the top line is green, it means that on 1, 2, 3, 4 time frames, the MACD is trading above the zero line. That's all that matters, right? So if you really looked at it, from this standpoint, you got a buy somewhere here around 76.88, and granted this drove up because of the results, but we look at other examples where results didn't come into play. So as you can see, if you really got the stock here, it moved from 76 to 97. I agree it's not the best of the examples, but we'll browse through a couple other examples for you to see what really happens when everything is sort of aligned, right? So now in this case, since all of this was kind of blank, you can sit it out, and here's maybe a good time when the trade was entered because everything got aligned. And so let's say you took the trade 134 and it's close to 139. So this trade is still up, right? So this kind of, in my opinion, gives the best opportunity for you. And again, I have some code that I can use for back testing, and so those results seem to be the best. So here's another example, right? So now you entered the trade here. Why? Because MACD is above the zero line on all 4 time frames, and everything got aligned here, as you can see. And if you took the trade, say around this price 217, it's up to 232, and in about 2 days. So not bad at all. And so again, as I said, there's more than one way of using MACD, but personally I've found with a lot of testing that I've done that this is kind of this offers you the best opportunity. So this is aligned this time. You enter the trade here, of course it retraced, right? As you can see, once you get a yellow, that means it dropped below the zero line as it did, and then it propelled back again, right? So if you took the trade here, say around this price, which is 188 to where it ended, you have a pretty decent profit, right? So let's look at REGN. And so there's I can give you numerous examples, but what I'm going to do is, I'll do maybe 1 or 2 and stop. So this is the example of REGN, right? So the 4 time frames got aligned right around here, right? So that's 577, roughly the price. And so far this hasn't broken. So 577 to 609. So that's almost $30 in profit here, right? So there's another example. We probably looked at this one as well. Lululemon, you get in at 278 and it's up to 300, right? We'll look at PayPal and see when it triggered. And it triggered around this price, right, which is 150, and it's trading at 154. So these are just a few examples, and as I said, you can switch back into the other mode, right, the primary, the secondary. Now let's look at both, right? In this case, both conditions have to be true. It has to trade above the zero line as well. It has to be trading above its moving average. So in this case, you get sort of much fewer situations when everything gets aligned, right? But hopefully we'll find an example where everything is aligned, so you can take a look at it. But those are far and few. But here's a good example, where it entered the trade here. So this basically, when this is green, it's telling you 1, 2, 3, 4 time frames, MACD above zero and MACD above its moving average in 4 different time frames, right? So we can back test here as well. Is another scenario when it happened, right? So you entered the trade here around 261 and closed it around 274, right? So anyway, so in terms of back testing, from my vantage point, I see that all you care about is MACD to be trading above the zero line, but you need confirmation from 4 different time frames. So hope this helps. I will see you in my next video. Talk to you soon. Bye bye.